Thank you for being with us. We have two competing factors. The virus is getting a bit of fear in the system, but the biggest competitor we had today is a good news. It's the deal industry, which is just red hot. And we had a lot of people sending an email this morning or yesterday saying, my closing is not there yet. Sorry, I'll have to come only for dinner or only for lunch. And so hopefully this will be the peak of the day. So to start our panel on Jumbo Deal, handling Blockbuster transaction, I'm happy to have Thierry Timsit, CEO and Managing Partner of Astorg, which used to be a mid-cap fund, so they've grown to the challenge with the industry and raised to prominence. Michael Ogrins, Managing Director at Advent, who also has built a fantastic firm with a fantastic team all across the globe. Jonathan Gibbons from Alvarez & Marsal, who was a boutique restructuring firm 20 years ago and has now also spread its wing across the different segment of the industry. And me as your moderator. So to start us with, maybe a question on, what's specific for Blockbuster deal at the pre-deal phase. And pre-deal phase can be split probably between before the go gets done, meaning before the info memo is sent and the access to information. So what's specific to the pre-deal phase before the kick-off is given? What type of preparation do you put to access those deals and to prep those deals? Mayor Thierry?
Thank you. I'm not sure it's that different. It's a matter of volume. I mean, you have a lot more to deal with. You have a lot more information to digest, and a little more complexity in the companies that you acquire. So basically, I mean, you need to focus on what matters. I mean, I would say, which we should always do, but in the case where there is just too much information, it's even more the case. So the preparation means. In our case, I mean, this is the way we work. I mean, we tend to approach companies a year ahead of a potential sale. So we work in all the cases, jumbo or not jumbo. And by the way, I'm not sure I understand what jumbo means, but you really have to understand the company before it comes on the market. And in the case of a very large deal, which is complex by its sense, you need to put more people on the ground and focus really on the areas that matter, on the fundamental aspects of the deal. So it's a very general answer. And you have to assemble a team of advisors, which as well, you go for a larger advisor because you are going to need a lot of people on the ground at the same time. There is a marathon phase, which is, you really take the time to understand, and there's a sprint phase where you compete with people like Michael, and they have huge resources, and you really need to go fast because once it's open and once it's for sale, you have the same amount of time as usual, except that it's a lot more complex.
So more information, but that means you have to go to more clarity of what to look for?
Yeah.
What's the maturity syndrome, so to speak?
It's more about, looking at the divisions which are really going. Usually it's very multi-divisional instead of a mid-cap company which is going to be just one business or just a couple of businesses. There you are going to have a lot of divisions, so you focus on the divisions which are going to create the growth of the company. And this is where you put your attention. It's not really a matter of materiality in terms of amounts, but really of amount of growth.
Okay. Michael, do you want to nail this one?
Yeah, good morning, everyone, and can only agree with what Thierry just said. The incremental layer of complexity on the larger transaction is often there. They're very complex, smaller businesses as well, so that direct link between the size and the complexity is not as obvious. But if I make one other simplification, I guess quite often these larger businesses are very international, sometimes already global. And when you talk about international and global businesses, the market dynamics, the market specificities in each of the regions are obviously very different levels of maturity vis-a-vis a service or a product. And what we have found over the years is that one efficient way of tackling that international complexity is combining our forces across various offices. And so we have seen over the last 10, 15 years a significant increase in prevalence of deal teams that are multi-office, sometimes multi-continent, just to be able for us to field the right resources to tackle what Thierry mentioned, i.e. the core value triggers. And that's, in the essence, I think one big difference when size grows is that you are tackling international complexity, that, from France, sitting in Paris, you may misread what is happening in China, in Latin America, or in the US. And certainly at Advent, we have the luxury of having offices a little bit all across the globe, and we really mobilize those offices, even in the pre-deal phase, very actively to get to the bottom of our conviction to be the next owner.
Yeah,
So just one quick addition is, as we've grown, and as you mentioned, I mean, we've grown from small to mid cap to large cap. You get more and more organized by sectors instead of geographies. So, I mean, in the end, I mean, like all the large funds, I mean, you end up having both and working in the matrix. But really, I mean, the sourcing and the analysis of the deals are made by the sector teams, which are spread across. I mean, as Michael, I mean, we have offices in New York, we have offices in Europe, and they work together. I mean, it's the sector who works. And then you want to have a local element to understand what's going on. So, I mean, we also have geographic partners, but you end up with a mix. And to Michael's point, I mean, it is very much a hybrid exercise.
And to your point, Astock today is about 200 people. And
250.
250, sorry.
No,
and
150, I'm sorry.
150. And less than 1/3 is in Paris. You have office in London, New York, and
Actually, I mean, in terms of offices, I mean, Paris is today. I mean, we have 3 hubs. We have Paris, London, and New York, and Paris is the smallest today. It's really the London office has outgrown the rest, and this is just if you want to recruit non-French nationals, it's much easier to recruit them in London than in Paris.
Maybe about the deal size during the marathon phase. How many people would you put in the sector and the marathon phase? Is it like 2, 3, 4 people, and then it switched to like 7, 8 person?
Yeah. It's exactly that. Yeah. I mean,
okay. And Michael, with your network of office, including Latin America and Asia, in the marathon phase before the info memorandum is sent, how many people would you put when you want to win the auction? Or you think you want to win the auction?
I mean, I think initially, right, every project starts with an idea and an emerging conviction, and that lies with 1, 2, 3 people, right? That's what you need, because initially you just need to put the energy and the focus to firm up the working hypothesis, or what we call what you need to believe, right? So, what is it that you need to believe on this opportunity, this asset, to have at the end the conviction to pay the price to win? And that is hard to spread out across a large team, right? And so we really scale up the teams when we start to go into execution phase. That sometimes happens, 9 months before an auction without access to information, because we want to be, ready before the process starts. Sometimes it starts when there is access given by the company. So that really is not necessarily driven by the sell-side decision of when they open up the process. It's driven by our decision of how we want to play that specific situation. But yeah, small teams initially, larger teams later. And at the PE side, it's never a huge team, because then the knowledge gets too disseminated. At least our belief is putting 20 people on a deal makes no sense. Even with large complexity, we then rely on our advisors to basically bring the thought and leadership across the various issues that we have to tackle to help us, and then it's coordinating all of that and bringing that down in our diligence that is the critical element.
Jonathan, your firm has been advising large cap funds all across the globe, and mostly in the US originally, and now all across Europe. How do you see the different way funds make their preparation before the auction?
Yeah, thank you. I mean, we're a global advisory firm. We have about 6,000 people globally with 2.5 billion revenue. So we're present in every major city across the globe, across Europe. We're perhaps 1,500 people now in Europe. So we do advise our largest clients, large cap PE, large corporates working on these jumbo deals. We find the best thing is to make sure everyone's clear on the scope, the equity story, the bidder appetite, and what's important for the preparation. I think having that clear upfront is really clear to success, ensuring that everyone's on the same page on those important pieces. And then we assemble the best team on the largest projects. We've got one at the moment with maybe 25 people globally in France, UK, in Brazil, India, US, etc. And we have a single team working on that to, I guess, sprint and go as fast as possible to prepare things. I mean, we do find that having a strong team working fast is a good way to prepare things, rather than, I guess, a lighter team and letting things drag on a bit over, say, 12 to 18 months. Better to just go fast and get things prepared quickly.
So focus team, commando style.
Yeah, that's right. Yeah, that's the A&M style. Yeah, indeed. Yeah.
Okay. So it comes from the restructuring roots, I guess. Yeah. 2 billion. So to answer the question, the threshold for this topic will be Jumbo starts at 1 billion. Maybe now if we switch to the deal phase, how do you address this deal phase on the team level, but also interacting with the management? When a deal starts, the management team is very powerful, is probably a bit more powerful, used to having its way, so to speak. So how do you team up with the management to build a vision, especially when he knows there's so much dry powder and he pretty much gets to pick? And maybe my assumption is wrong. Maybe Thierry, do you want to start, or Michael?
I can start. I mean, we want to align on clear strategic objectives. I mean, this is how we, I think, get the management teams on board before the deal and after the deal, which is we are not going to help you manage the company on a day-to-day basis. I mean, increase the EBITDA, reduce the cost. I mean, we can help, and with the help of consultants. But if you reach a certain size, and we are talking about jumbo deals here, they know. I mean, they don't need you. They know the consultants. They know how pricing works. They know how economies work. So basically, where you can really help them is by giving them clear directions of where you want to head, because this is what the shareholder is all about. I mean, it's steering the company. And you have a dialogue, and this is the way we get them on board, which is, okay, there is the investment thesis, which is why we want to buy the company, what are the assets that we like in the company, the equity stories, what we want to tell when we exit, and the middle is what drives the company from the investment thesis to the equity story. And it's actually the objectives, the key strategic objectives that we want to implement. So on each of the companies, we want to have clear strategic objectives that we will pursue. I mean, 3 of them, simple, measurable, public, I would say. We even tell them to our LPs, and which are going to get the company to where we want. We may get it wrong, I mean, in terms of either the objectives or the execution, but at least we know where we want to be going. And this is hugely powerful for the managements, because they know what we want, and therefore they can resource the company accordingly. So that's how we get things done. And the strategic objectives, as they are named, I mean, they have nothing to do with operations. In those large companies, operations, I mean, normally, people know what, they should be doing. Maybe, I mentioned pricing. This is maybe one of the exceptions we see across companies, where CEOs are a bit shy and they can need some help. But the rest, they pretty much know what they're doing. So if I want to illustrate the point, and it can be very simple. On a company like Solina, which is, it's a 1.5 billion company. When we acquire it, it's a 5th LBO. So you might say, what the hell are you going to deliver on this? And it's just, the company is very European. We think that it will have more strategic value, hence more multiple, if we make it a global company. So we want to internationalize it. It's very simple, but in fact, we want to reach 30% of our sales in the US by the time we sell in 5 years' time. This is not going to happen organically, given the size of the company. So it's going to happen by M&A, and you need to be fast. And if the management knows that this is one of your 3 key strategic objectives, they will resource, and we will help them. The M&A team accordingly. We've already done 3 acquisitions, add-on acquisitions, 5 months down the road after closing, and all in the US. So that's the kind of thing that you do to get your management on board. I can give many more examples, but I'd like to share the floor.
Michael?
Yeah, I mean, the question, I guess, was, how do we convince management teams to hopefully team up with us and not with our competitors? And ultimately, it goes to what they perceive we can bring to them, right? I mean, and that's not just, money and the management package. It's
Smart
for those who really want to drive their business forward. They really ask themselves the question, are these the right partners to take the right risk decisions along the way, right? Because when we're talking about developing businesses, growing businesses, at every step of the way, there is active entrepreneurial risk-taking at stake, right? And so the judgment that we have to help them form is, do we understand their world, business, and challenges well enough to be the right partner to take the right decision at each of these crossroads? And, when, like Thierry described, the objective is to internationalize the business, are we the right partner to bring them the support they need to do that? If it is building a low-cost factory in China to basically, ensure the longer-term productivity and competitivity of the product or the service, then are we the right partner to do that? So I think there is a bit of a situation-specific matching between the skills and specificities of each of the funds and individuals in the funds and the specific, thesis and challenge. Now, we may all look pretty much alike from the outside, but I think every firm has a specific DNA, and that, I think, is really what we at least market quite actively to the management teams is, on the situations that we pick, hopefully we've been triaging them smartly and matching these opportunities, what we believe we can be helpful on as a partner, as being Advent, and then we market that aggressively to them, right? And to take one example, like Thierry, to illustrate that, is a recent deal we did in France. Was a purely French company called Circe, fantastic business network, leader in France in its business, but had never really traveled outside of France. The management team hardly spoke English, and the alignment with them when we did the deal was to say, guys, you've never done a deal outside of France. We've done hundreds. We're going to help you do that, and it's going to be a success. And 3 years later, the company has done 12 acquisitions. Half the business is outside of France, and they're very happy being now leading the European leader rather than a French leader. But that's the sort of step change where a financial partner like us can really be helpful and hopefully help move the needle. So you need to find the right match between what we can bring and what the company needs, and then that's most of the times how you convince them to hopefully at equal prices pick you, because if you're not at the same price, they may like you and you may be useful to them, but the seller will unlikely let you get away with it.
So if I wrap it up, you have to bring value that comes with sector expertise to understand what type of business they're in, what are the challenges the industry is about. You have to bring regional value with a network of office or a list of top acquisition to help them grow and outgrow themselves. You have also to bring them or to be with the right risk appetite, so they feel they're not just alone at the top. They have people who can take the right risk with them. And also simple objectives, and that's to you, Thierry. I was surprised when you said just about 2 or 3 objectives, not like a checklist of 25 things to do, but let's focus on 3 big ones to nail. Can you elaborate on this?
Yeah, again, I think it's a bit, when you acquire a company, you're going to manage a management team, somehow. And what do people, like from their management, and how do the best companies thrive? It's when there is clarity at the top. They know where the company is going, and there is also an ability to interact, the drive and listening. And this is, basically, if you want to retain talent, this is all it takes. Clarity, drive, and listening. It's the same with management. The CEO needs the same. He needs drive, to feel that you are, your resource to do what you want to do, and you really want to achieve that. You have clarity, you know where you're going. And you have the ability to listen and maybe correct sometimes. So there is a constant interaction.
A true dialogue.
Yeah, a very constant dialogue between the boards. Which are very formal. But as the company grows and as there are more and more subjects, the board is really about focusing on where things need to be fixed, or what's going wrong, and it's not a full review of the company. Really focus as well. So, and in between you have constant interactions. So those simple objectives I mentioned, one for Solina. I can mention a few more. I mean, in some of the companies we have, if I'm thinking about a company like Sabia, which, it's a company that's become well known and is a large company now, but I did the first buyout in 2000, when it was a primary deal from the founder. So it's gone through many stages, but it needed clarity at all the stages. One of the objectives that we had assigned to the company, which was a number 4 on its market in the US, was to become number 1. It's easy to say. We thought it had a lot of strategic value. It was very easy because it's the largest market in the world, but then how do you achieve that? One, by acquisition. So we immediately, on the day of the closing of the first deal, we acquired the US distributor of the company. So it was a double closing. And then we asked the company to put as much OPEX as was needed in the US to actually grow the market share. So that's, if you give, it's just one example, if you give a precise objective from a strategic standpoint, then your management knows that they can spend OPEX on the field because this is what the shareholders want. And there is no discussion about, it's 5% more, 5% less. It is directionally what we want, and we'll agree to that. The other objective is we wanted to walk on 2 feet. We had one product which was, I'm not going to enter into detail, but it was oncology linked. It was very narrow. We wanted to have another product to walk on 2 feet. So we really, pressed hard on R&D and it's always random because you never know what's going to come out of R&D. But we really had one product that looked to have the right size, looked to be diversifying the company away from a very narrow niche, and it was diabetes. So we really, pressed hard. And 6 years down the road, we had the first sales of the diabetes testing. And the third strategic objective was more from the organization perspective, which this company was defining itself by technology. We wanted it to define itself by pathologies. And so it was a complete shift, culturally speaking, that needed to put more doctors instead of just technicians and have a view of what doctors want. So it's medical marketing. I don't know how to say this in English, but basically the medical affairs become more important if you really want to pursue this objective. So I'm just giving you details here, but to tell you that, yes, it can really help steer the company. And I think, to my earlier point before I pass on, I think what the managements need is clarity and drive, just like any other people you're managing.
So first you need clarity at the fund team, and then share this clarity and align the vision.
Yeah, absolutely. We don't pretend that we have the truth. So it's a lot of exercise. I don't really believe in the 100-day plan. You have to, as Michael was saying, you have a couple or 3 people at the beginning which form a conviction, and then you bring the firm behind it, and you put more people, and you do the deal. In that phase, you form views about where, what's the equity story you want to achieve at exit. But then you confront that. Even during that phase, but you have less time. Then you confront that with the management team, with the CEO. He might have different views. Normally, he shouldn't, because you have shared that during the deal-making phase, and you adjust it. And it takes a lot of listening. And I think the worst thing that can happen is a deal team or a fund that comes in with very clear and fixed opinions about what needs to be done, and they don't listen to the management. And that's a recipe for failure. And so we listen a lot. We generally form a clear view after 6 months in the company of real interaction, not daily, but very frequent interaction with the CEO. And then, once we've listened and aligned, we act and we roll out.
Yeah. So the complexity, the paradox, is combining conviction and listening.
It is.
Jonathan, to...
Yeah, I think we've kind of said this, but one important point that we work on, and we work on when we work on jumbo deals, is combining the financial side with the operational side, and with a leadership with that. So I think just working on the financial side, you understand the metrics, that's okay, but it's really combining that with the operations. And when we discuss with our clients, what the strategy is on a deal, so what is the equity story, and with management, it's then understanding, well, how is that going to work in practice? It's operationalizing the strategy. And I think that's where, with our operational team, maybe it's within our European team, we have about 800, 900 people that are pure operators, not career consultants, but people that have spent 10, 15 years within industry. We find that on deals we can partner with a fund and work with the management of the target. And often these people know each other. Perhaps they used to be supply chain directors in competitors or in the same country, or plant managers or commercial directors or CEOs, CFOs, etc. And it's partnering the operational people together, with the target teams that help us work out together what the actual operational plan is in order to put in place a strategy. I think that's also a key to success, which helps our clients win deals, convince management, and find upsides as well.
And coming back to clarity, before they form a conviction, usually a lot of consultants spend work and hours and months, doing data work and knowledge work and insight work. How do you organize around sectors, and how do you bring clarity to the fund team?
Yeah. It's obviously sectors are critical. You're not credible on an operational side if you're not specialized within a sector. So, we work totally within sector teams on the financial and operational side, partnering with our clients, and it's really building that credibility and the practical application of the strategy, which helps create that clarity. So here's the overall strategy where we want to go, but here's how we're actually going to do it from an operational point of view.
And what part, maybe what part is to form the conviction? What part is sector and knowledge, or sector insight and know-how? And what part is function, like digital transformation as a function rather than a sector? Or, moving to less carbon into the industry process? What part is function, what part is sector? And can you bring something to the party there?
Yeah, I mean, on my side, it is a matrix. You can get transferable skills. Someone who's expert in optimizing purchasing functions can help, but it also helps if purchasing functions within, consumer goods is different to within a heavy industry, for example. So it's putting together the team with the right skill set, ensuring, I think, the sector operational focus is first, and the functional ability can leverage through that.
Based on the fund want to test where some performance can be improved, right?
That's right. So this helps build the equity upsides, EBITDA upsides, but beyond a benchmark process, it's a real granular plan of how we'll actually do it.
And winning the STEM auction.
Yeah, and that helps people win.
Michael, what's your insight on the deal phase?
I would probably nuance the pre-deal and the post-deal on that question. In the pre-deal phase on a very large transaction, I mean, there are thousands of pages, hundreds of interactions, millions of hours, probably not millions, but too many. And all of that sort of converges at the end on a very small group of people with limited time and limited also ability, frankly, just to absorb all of this, right? And so I think one has to realize that all of this is a lot of diffuse information where you try to extract what really matters to then get to the point of saying, okay, I want to own this company and I want to own it with this management team as a partner, and for that I'm willing to pay up to that price, right? And that's, when you boil it down, it's sort of super simple, and all of the rest is context. And if I had to pick within that context what will drive us to the conviction to do the deal, would by nuance be more the sector conviction and the actual belief that this company is strategically relevant for that sector, has a real path to become even more strategically relevant, so that in 4 and 7 years, people who were not interested when we bought it may get interested when we exit, right? So a different, better business which attracts different groups of people, because otherwise, what have we done to it? And why would we make money if it's not a better business? And so in that, for me, the sector wins. When we then own the business and we go around the execution plan and impose the rhythm of a 4 to 7 year LBO on the company, if it wasn't yet an LBO before, then clearly a lot of these functional expertise becomes super handy and helpful, because it accelerates the path to decision making, right? And so that is where, I guess, for us, at least on the Advent side, and our functional teams help more. So they are part of the pre-deal process. They inform the entire noise around the transaction. What is, does it smell like something we can improve and perform better on those dimensions? But we won't do a deal because of that. We will do a deal because we like the industry, we like the perspectives that specific business has, and we like the ambition we can put behind our equity thesis. And so we're a sector-driven firm, and so clearly the sector wins in the decision making.
So if I try to crack your response, it's finding the right tailwind with the right plane and the right pilot in the plane.
Yeah, it's
It's exactly that. Yeah, and being able to change the roadmap if you need to, and making sure the pilot wants to land where you've decided you wanted to land. Otherwise, you have a problem. You may discuss, but. Yeah, and some, I mean, I'm coming back to your point about what you're doing in the company. I mean, is it just strategy, and sometimes it's operations? I mean, as was said, and I have another example. I mean, we bought a large company in the US called ERT. It's basically, I mean, I've simplified. It's the digitalization of clinical trials. We were this has 4 divisions. We were number 1 in 3 of the 4 divisions, and number 5 in the 4th. I mean, basically virtual, I mean, a very small market share. So our simple play in that case, and we focused the management really hard, was we want to become a number 1 in the 4 divisions, because it's going to add value when we sell the company, to be perceived as a clear leader across the board. By the way, the 4th division is where the highest growth was as well. I mean, it's imagery. So day one, I mean, we focused all our attention and the management's attention on buying a company called Bioclinica, which was in imagery, was a 1.8 billion business. So I mean, it's basically not a small acquisition. It's quite transformative. We were lucky enough, and we've put what was needed to manage that, to do a bilateral basis and acquire that company. So that was a check on the third strategic objective. First one was that this company was cross-selling approximately 30% across its 4 divisions, which was absolutely not normal. I mean, given you're selling to the same clients, the big pharmas. So we said to management, okay, we want cross-selling to reach 60% when we exit the company. So that comes to more operational things. And then, I mean, where you must bring either functional leads, because, I mean, the cross-selling is going to be achieved through digitalization. So if you have digital experts, you have to bring them in, or by bringing external consultants who are experts in cross-selling and are going to help that happen.
And I mean, this echoes, frankly, this we call it fit for exit, right? Which is what is on the one pager, the elements that you'd like to have in place on the fit for exit, and are you on the red or on the amber or the green, right? I mean, this is sort of consultancy talk here, but at the end, you have to be able to simplify to that level, also to keep track, frankly, of in an honest way of progress, because what is important is to keep a healthy distance to your own portfolio companies as well, to be able to reassess the roadmap, right? Because sometimes the initial idea was just not the right one, and you have to course correct. And you need a simple tool to even challenge yourself as the deal owner, right? I mean, the deal partner incarnates the deal, and we need to remain with a level of distance that allows us to, basically say we got it wrong and let's do it differently. And for these simple tool that says, okay, that was the objective, it's not possible to reach that for exit. So we need to take that objective away and reset the clock on something new.
I don't know for you in the room, but what I'm impressed is the clarity of thinking, because you can be just swallowed by the complexity of fact and factors and stuff, and you guys try to keep a clean head and a top-down approach, and at the same time listen. Maybe switching to the deal phase incentive schemes. What are your conviction about winning the deal by aligning the vision, but also aligning the numbers in terms of sharing with the management team and or with a broader circle? Maybe Michael, do you share a bit? Do you share a lot? Do you share with the first circle, second circle, the full company?
I'm a big believer that the governance and ownership model of a private equity setup is, a superior ownership and governance model to many others, not to all of them, but to many others, because it creates indeed the alignment of and not only economic interest, but also of sense of purpose and of ownership between the board, the shareholders' representatives, and the management. And so that alignment, I think, is one of the things that differentiates an LBO from a public company ownership, from the division ownership of a large corporate, because there is no political agenda there, right? Everyone is in one boat. There is just one boat, And if the boat, gets to the right harbor, everyone is happy. And if it, sinks, then everyone sinks together. So there is no one gets out on top and no one gets down on under. Either everyone is on top or everyone is down under. And so that is the beauty of it, right? You can't divorce along the way. You just, you have to, you're in there for good and for bad. And we have faced storms in companies, things have gone wrong. And the resilience of our ownership is that we then, we don't drop it. We effectively, work with the companies to try to get them out of their holes. And so that alignment is critical, and it goes through economic alignment as well, but it can't be the only one, right? And then, do we want to share? I mean, the more they get, the more we get, and so that is great. Now, France is a particularly generous market with management teams. Other markets are slightly different. And so we don't apply the same rule to every market because that's not the reality. And so a management package in the US looks different than in London, and it looks different than in Paris. And so you have to adapt to the headquarter and to the counterparts to adjust your sharing with the management team. But that's just the cultural specificities of our business in each of the regions where we operate.
So, if I understand it first, that's the superiority lies into the incentive schemes, sharing more than family business where just the CEO gets some type of big bonus, or the listed company who sometimes are pro management, sometimes very against management. You can go from one to the other with Elon Musk on the one hand, and people tackling bonuses on other companies, listed companies. And the second thing is you basically share a lot. You're willing to share. First, second, and third circle. What about Astorg? Are you a sharing guy?
We're just exactly the same as what Michael's described. I mean, we share, and we think it's the right thing to do if you want to align. And this is, effectively, the business of private equity is really compressing time, and you compress time if you have clarity in the objectives and if you align the interests. So it works. It works differently in different countries, as Michael has just said. It also works differently, I think, for different types of people in the company. If you, I don't know what, Circle One, let's say it's really the core executive committee, and then you have a Circle Two with all the managers, and then you have a Circle Three with the rest of the company. The rest of the employees do not necessarily see a clear correlation between their work and the EBITDA and the value of the shares that you would be giving to them, or a management incentive package. So I think, for reasons of understanding exactly the relationship, for reasons of preference for cash, for reasons of a different relationship to risk, you have to adapt and actually craft different tools within the company. So I think it's a must to have a perfect alignment in equity with the Circle One, and probably Circle Two with a little bit less risk. Circle Three is more about, very often is more about bonuses, because it doesn't make a big difference, and quite the reverse. It can actually create a lot of tension. As we said, things do not always go right. So, and if things don't go right, then you create a lot of tension and stress in the company if everybody's put their, wealth or part of their wealth in the company. So bonus, sometimes I would advise more. We've got a long way, because first deal I mentioned Sabia. Sabia, we were probably the only ones, or the first ones, to offer shares to every employee in the company. This was back in 2000. So it was not done, and we had problems with the AMF at the time, because they said it's an appel public à l'épargne. And we had problems in other countries. So it was difficult, but we've done it, and with hindsight, was not necessary and probably not the right thing to do.
So because people have different horizon and level of comprehension, you should have the same goals, but different time horizon leads to different type of incentives to align the interests.
Absolutely.
Jonathan?
In terms of management incentives, I agree with everything that was said. I think for the management, the important thing is once the deal's signed and done, it's preparing the next steps and executing that. Thierry says he doesn't like 100-day plans, so we'll call it something different. When we do that. But I think it's once the management team is there, you need to back that team. There can be instances when they need to be changed, etc. But typically back the team, leverage the team, We push for doing deep transformation and value creation from day one, pushing that through as fast as possible. Often the management team are absolutely the best people in the role that they're doing, but on their own it could take them 2 or 3 years to do something that you can do in 3 or 4 months if you really accelerate with a senior team. So I think that's our view on management post deal.
Thanks.
And one thing I like to add is, we were coming from jumbo deals and how to, implement that in a jumbo deal context. And, management teams, in the diligence phase, you will only meet a few of them, right? Because it's in a large company, there will be probably 50 people who really matter, where in a small company, maybe 3 or 4, not mattering in terms of their importance but just to really steer the ship. And so you need to, go and meet as many as you can after you own the business, because that's the only way that sort of common alignment trickles down. And then the second comment I'd make on that is, how do we govern these businesses? There is a one-on-one relationship between a few people, between the shareholder and the management team, but then there is a body that is called the board. And we're big believers that the private equity governance through the board is a super efficient lever only if you have what I call the purpose-led board. So we don't recruit board members just because of their experience and being great guys in what they did before, but we entrust each of the board members with effectively one of our famous, fit for exit objectives. And we pick them specifically for that objective. And I go back to the example I mentioned before in Circe. Circe, 100% French company. The objective was to make it international. When we put our board together, there was not a single French person on it. Mm-hmm. There was an English guy, a German guy, a Swiss guy, an American guy. Why? Because that's what we needed, right? We wanted to go international, so we don't need the best French telecom expert. We need the best English expert, the best German expert, the best Spanish expert. And so that's what I call the purpose-led board. And the bigger the organization grows, or is, the more you need that board to be purpose-led, because otherwise it becomes a reporting session and not a value creation session. And it's such an important government body in a private equity context that you really need to think hard on how to use that body for actually delivering on the plan you set for yourself.
So if I may crack a joke, the board is a translation company to help translate the goal into good execution, to help. So, maybe we're about to go into the presidential phase in France, and the classic question to potential candidates is, what will be your first visit? What will be your first move? So maybe to Thierry, you just won the auction. What's your first decision, or what's your first move in the first week or so to onboard the company into your portfolio and to help them execute?
It's a funny question. I'm not sure I have one answer that fits all. Basically, the general answer is that it will be spending half a day with the CEO of the company to really go down all of our due diligence and our findings and recheck, and beginning the rechecking of the strategic objectives that we thought were going to take us to the fit for sale, or fit for exit. So this is what I would do. It takes a lot of different nuances, but essentially this is what we do.
Okay. Jonathan, what do you do in post-deal? Do most funds who work with you ask you to implement the 2-year plan or the portfolio lifetime value plan?
Absolutely, because that's what we do. Pre-deal execution phase, as I mentioned, the operational and financial analysis, but it's with a view to operationalizing that post-deal. So it's the plan straight after signing, up to pre-closing even, and then post-closing when you can act more is really putting that, doing the execution for that. Yeah. It needs alignment on strategy. It needs that first meeting with the CEO, alignment with the sponsor. And once you've got that support and that clarity of direction, then it's putting that into practice as soon as possible.
And maybe just one testing question before Thierry jumps in. Would you say people go to Alvarez for the strategy insights or more for the help on execution?
Well, I think it's the experience on the financial and operational side.
You're more known for operations, right?
We're both actually. I'm actually, my execution is on financial. I work together with our operational teams, and we do an integrated service. So it's I think people come to us for that operational expertise, pre-deal and then post-deal.
It's just one very quick addition is that the thing we do very rapidly once we've acquired the company is we go out and try and visit as many sites as possible in the company and meet with as many possible people as well to get a different story from the one we got from just the top management team. That's one thing we systematically do.
So you're still learning post-deal by connecting with the different management level and site level and regional
Absolutely.
level.
Hence, you know, my doubts. I mean, it's not that I don't like the word 100-day plan. It's just that I think it's a bit too early and a bit simplistic.
I see that my fellow panelists are much more serious than I am. I take my family for a long weekend and actually try to catch up with them. No, but I think the last point that Thierry made is probably what I would have answered, i.e., you know, especially in a large deal, you have met so few people out of those who really matter in the company that you have to go and travel the world effectively to meet as many as you can. Maybe with a slightly different objective that I would have mentioned, which is, you know, putting a face to the shareholder and hopefully a friendly face to the shareholder, right? You don't want to be an abstract, hey, who are these Advent financial guys up there? You want them to see, you know, Peter, Paul, and Joe who work for Advent, who actually, you know, love my business, understand my business. You know, they will always be surprised, given we've done 3-6 months of work. For someone who's not in the industry, we by then know quite a bit about their industry. And so make the positive impression, tell them that you like what they do, that you're enthused by the challenges of their industry. And then when you walk away, they're sort of, oh, we have a shareholder who, you know, came and visit us and seems to understand what we do and has the same objectives as we have. Because they've never met their board members before, right? They don't travel usually to all the provinces. They have rarely met when they have a shareholder in person. So incarnate the ownership and make it hopefully a friendly face that they are enthused of working with.
Thank you. We have to close quickly, so maybe a word of conclusion on each of you. Thierry, first, your website says listen and learn, then understand, and then act. What can you add with big deals?
Just exactly the same. Listen, align, act.
Okay, thank you. Michael?
How to conclude on a vast topic like that? Yeah, I think, you know, it's still people, right? I mean, no matter how big the business, the people who run it are just, you know, human flesh like you and me. And so, you know, focus on the people, try to create relationships with as many of them as you can, and you know, and team up with the best, because if they're not the best, they will not sail your ship to the safe harbor. So that's the other.
So people in the management team and people at home. So if it's a really big deal, do you get 2 weeks with your family? Jonathan?
Yeah, no, I would agree on the people point. I mean, our strapline is leadership, action, results, and leadership really is the people that you're working with within the deal team and with the management team. I think that's an important point.
Thank you to all of you for listening and taking a time off your deals to share the insight, and help me thank the panel here for sharing such good insight. Thank you.